Richard and Carol thought one large Roth conversion would simplify retirement. Then their projection showed higher Medicare premiums 2 years later. Richard is 64. Carol is 63, and they have saved well. Most of Richard's retirement money is still in a traditional IRA. The conversion was not automatically wrong, but the amount and the year both needed a second look. Their CPA places 3 choices on the table: a smaller conversion, a middle option, and a larger one. Richard leans toward the largest amount because he wants less money left in the traditional IRA. Carol asks a different question. How much cash will the tax bill use? That question changes the entire meeting. A Roth conversion moves money from a traditional IRA into a Roth IRA. Untaxed amounts are generally taxable in the year of the conversion, and that taxable income may later become part of Medicare's IRMAA calculation. Social Security generally uses tax information from 2 years earlier when it sets income-related Medicare charges. The largest option reduces Richard's traditional IRA the most. It also creates the highest tax estimate and the greatest possible Medicare impact. So this video is not about avoiding Roth conversions. It is about testing how much to convert, which year to use, and how you'll pay the tax. Those are the 3 dials in the Roth conversion test. Use this as education and as a starting point for a conversation with your CPA, advisor, or Medicare professional. Richard wants fewer required withdrawals from his traditional accounts later. Carol wants to protect the cash reserve they worked hard to build. Both goals are reasonable, and neither one belongs in a footnote. The trouble begins when the conversation stops at the tax bracket and never reaches cash flow or Medicare. Until this meeting, Richard and Carol had asked only one question. How much can we convert this year? A better question is, what does each conversion size change? The answer can affect tax now, future IRA withdrawals, available cash, and Medicare premiums later. By the end, you will have a simple way to compare those trade-offs before December 31st. Their timing matters because Richard and Carol will not start Medicare in the same year. One joint tax return may reach 2 Medicare timelines at different times. A higher income year is not automatically a mistake. It simply needs to be understood before it is created. Let's start with what a Roth conversion actually changes. A traditional IRA usually holds money that has not yet been taxed. A conversion moves some of that money into a Roth IRA. A conversion is different from making a regular Roth contribution. You are moving existing retirement money from one tax treatment to another. The untaxed portion of the converted amount is generally included in taxable income for that year. Qualified Roth withdrawals may be tax-free later, but the current tax bill is real and needs a funding plan. A conversion may also leave less money in the traditional IRA, which can reduce future required withdrawals from that account. If the IRA includes after-tax basis, the calculation can be more complicated. That is one reason the tax records matter. The projection should use the household's actual IRA history, not a rough guess from an account balance. Now connect the conversion to Medicare. IRMAA is an extra income-related amount added to Medicare Part B and Part D costs. It is not the late enrollment penalty. It is a separate adjustment tied to income. For IRMAA, MAGE generally means adjusted gross income, plus tax-exempt interest. In plain English, it starts with the income total on the tax return and adds back certain tax-free interest. Social Security generally looks at tax information from 2 years before the premium year. Because Carol is 63 and Richard is 64, the same joint return may affect their Medicare costs in different premium years. That is 1 return, 2 start dates, and 2 chances for confusion if the timeline is never written down. Before adding a conversion, start with the income already expected for the year. That may include wages, consulting income, pensions, interest, dividends, IRA withdrawals, and taxable investment gains. The conversion sits on top of that baseline rather than replacing it. That is why conversion size matters. The same dollar amount can create a different result for two households with different baseline income. IRMAA works through income ranges, so a relatively small additional amount may matter when a household is already near a range boundary. For Richard and Carol, the middle option lands much closer to a Medicare range boundary than they expected. Using every available dollar in a tax bracket is not the same as choosing the best overall conversion. A future appeal should not be the foundation of the plan. A planned conversion does not automatically disappear from the IRMAA calculation simply because the strategy was thoughtful. Now Ellen, their CPA, places the three conversion sizes side by side. She uses the same assumptions for each option so Richard and Carol can compare them fairly. The goal is not to crown the biggest conversion as the winner. It is to see what each option buys and what it costs. The smaller option creates the lowest conversion income of the three. It preserves more of their cash reserve and produces the smallest current tax estimate. But it also leaves more money in the traditional IRA for future years. That may mean larger future IRA balances and potentially larger required withdrawals later. Richard worries that the smaller option does not make enough progress toward his long-term goal. That does not make the smaller option a failure. It tells them which trade-off they are accepting. The middle option moves more money into the Roth without using as much cash as the largest option. It meaningfully reduces the traditional IRA and still leaves the household with a comfortable tax reserve. Depending on their baseline income, it may still affect Medicare premiums later. The middle option is not automatically safe, and the large option is not automatically wrong. Carol likes the middle option because she can see the remaining cash reserve on the same page. Feeling financially secure is not separate from the math. It is one of the planning inputs. The largest option moves the most money out of the traditional IRA this year. It creates the biggest current tax estimate and the largest possible Medicare impact of the three. It may improve future flexibility, but the household gives up more cash today to get there. How the tax is paid also changes the result. If money is withheld from the conversion, less of the original amount reaches the Roth. Michael, their advisor, compares paying the tax from outside cash with paying it from money that would otherwise be converted. This is the third dial, and it is often missed. Using cash outside the IRA can allow the full selected amount to reach the Roth. But that choice reduces the cash available for emergencies, travel, and the first years of retirement. Cash is not idle just because it is not invested. A reserve has a job. Using part of the converted money for taxes protects more outside cash, but leaves less in the Roth. Richard and Carol can now see that how they pay the tax changes the outcome, even when the conversion amount stays the same. There is no universal winner hiding in these three cards. Each option is compared across 4 results: tax now, future traditional IRA balance, cash remaining, and possible Medicare impact. Ellen and Michael review those 4 results together instead of handing Richard and Carol 2 separate recommendations. Once the trade-offs are on one page, the decision becomes easier to discuss. Richard says reducing the future IRA balance matters most to him. Carol says she can support a conversion only if their cash reserve still feels comfortable afterward. Those are not competing emotions. They are 2 parts of the same retirement plan. The team then compares doing the conversion this year, next year, or across both years. Ellen models a split conversion using the same 3-size framework in each year. Splitting a conversion does not guarantee lower lifetime tax, and it does not guarantee that IRMAA disappears. It does, however, show whether one crowded income year can be replaced with a more manageable sequence. Richard and Carol choose a middle-sized conversion this year and schedule another review before deciding on next year. They do not choose it because the middle option is always best. They choose it because it fits their current income, cash reserve, Medicare timing, and long-term goals. They reduce the traditional IRA, keep the reserve Carol wanted, and understand the possible Medicare cost before acting. An expected cost feels very different from a surprise notice. Their calendar now includes a second review before any additional conversion. The decision feels deliberate instead of rushed. Now let's turn their meeting into a process you can use. The Roth Conversion Test has 3 dials: how much to convert, which year to use, and how you'll pay the tax. Dial 1 is the conversion amount. Ask for at least 3 sizes: smaller, middle, and larger. 1 proposal gives you a recommendation. 3 proposals give you a comparison. For each size, compare tax now, future traditional IRA balance, cash remaining, and possible Medicare impact. The CPA builds the tax projection using the same income assumptions for every option. The estimate does not need to predict every dollar. It needs to be consistent enough to reveal the trade-offs. Begin with baseline income before the conversion is added. Include the income already expected for the year, not just the amount you hope to convert. Then add one-time items that may already be on the return, such as an investment sale or delayed compensation. If the conversion size changes, rerun the projection instead of assuming the result moves in a straight line. Dial 2 is the conversion year. Compare this year, next year, and a split across both. Place the expected income for each year beside the proposed conversion. A lower income year may create more room, but tax rules, cash needs, and retirement goals still belong in the decision. Add both spouses' Medicare start dates to the same timeline. Do not assume the household has only one Medicare year. Carol's age 63 year and Richard's age 64 year make the timing visible for their household. The same joint return can reach their premium calculations at different times. Dial 3 is how you'll pay the tax. Compare outside cash with money withheld from the conversion. Ask where the tax will come from and how much liquid cash remains after it is paid. For Carol, that remaining reserve is the difference between a plan that looks good and a plan that feels usable. Put all 4 results on one decision board. The board should show tax now, future traditional IRA balance, cash remaining, and possible Medicare impact. Bring the CPA, advisor, and Medicare professional into one coordinated review when the decision is large enough to affect all 3 areas. The CPA studies the tax result. The advisor studies the portfolio and cash. The Medicare professional explains the premium timing. No single professional needs to guess at the other 2 jobs. Complete the review before December 31st, while the current tax year is still open. Confirm 5 items: the amount, the year, how you'll pay the tax, other income, and both Medicare start dates. If the conversion still makes sense and IRMAA is part of the trade-off, include that cost in the plan. A higher premium does not mean the conversion failed. It means the cost belongs in the comparison. If a notice arrives later, check the tax year and income used. Then ask whether corrected tax information or a recognized life-changing event applies. Do not build a conversion strategy around the hope that a future appeal will erase planned income. The 3 dials give you a repeatable process instead of a one-time guess. Here is the final checklist. If you are 60 to 62, identify the years available for conversions before Medicare begins. Compare those years with expected retirement dates, pensions, investment sales, and other income changes. If you are 63 or 64, compare at least 3 conversion sizes and at least 2 possible years. 3 sizes, and 2 years can reveal choices that one large proposal hides. If you are already on Medicare, begin with your current income baseline and ask how another conversion may affect a future premium year. If you receive an IRMAA notice, read the tax year, filing status, and income information before deciding what to do next. Before converting, answer 5 questions. How much are we converting? Which year will carry the income? Where will the tax payment come from? What other income is already expected on the return? Which Medicare premium year may later use that tax information? Answer those questions before the money moves, not after the return is filed. Richard and Carol leave the meeting with a written amount, a funding source, and a date for the next review. A Roth conversion near Medicare is not a simple yes or no decision. It is a decision about how much, which year, and how the tax will be paid. If this helped, subscribe to Tom's Medicare Blueprint for calm, plain English Medicare and retirement income planning. Comment the word Roth if you want the 3-dial checklist. The rules are written to confuse you, but we're here to decode them together, one decision at a time.